Hello and welcome to Extreme Crypto. Today we'll be talking about risk management, how to insure your capital, the definitive guide to safeguard your trading capital. You might have been hearing about risk management a lot. It is what is flying around. Whatever the commodity you trade, whatever the market you are in, you always hear risk management. But it's only few traders that actually manage their risk, because trading is very risky, so you need to manage the risk. This is the reason why almost 90% of traders are losing money, and also the reason why people are failing in cryptocurrency trading. This is also the reason why I have lost money in the past too, because you think you know what you are doing and you know how to manage the risk, but if you are not strict with your risk management, you keep losing money. So that is why professional traders, they have a very strict risk management, because they know that they might go wrong many times. But what will make them stay in the market and still be trading in the market is having a strict risk management. This is what most newbies don't know. They just think that just going into a trade and you get it right. Most of the time you might not get it right. So what you need to do is to have a very strict risk management. And when we are talking about risk management, it has a lot of things involved in it. And the number one thing we'll be talking about today, the things you need to know, is trading capital. That is the first thing, followed by stop loss, and followed by position size. So let's start with the trading capital first. Trading capital now, the first question, or one of the rampant questions in cryptocurrency trading, is how much do I need to start trading cryptocurrency? Actually, what I usually tell people is that there is no amount that is too much to start cryptocurrency trading, but there are some amounts that are too small to start cryptocurrency trading. So for example now, if you want to start cryptocurrency trading, I usually advise people to start with something within $1,000 above. That will allow you to be able to trade with a good position size, because if you have anything lower than that, your position size might not be buoyant enough to give you a good return. So it is very important to note your starting capital. If you have a trading capital now, what people don't know is how to protect the trading capital. So if you have a trading capital, let's assume that you are starting your cryptocurrency trading with $1,000. This is the amount you're starting your cryptocurrency trading with. So if you want to risk your money now, because every trade you do, every position you open is a risk. So how much are you allowed to risk in your cryptocurrency trading? So majorly, some people usually bring the idea of risking 1% of your money, and if you risk 1% of this $1,000 now, 1% of this $1,000 is $10. So what I usually tell people is that it is actually a very small money for people that are actually just building the account, because $1,000 is actually not a big capital when it comes to trading cryptocurrency. So for people that are just trying to build the account, it's just like you are starting a business. Your trading capital, your business capital might not be that much. So if you are not careful, you have to blow it. So you need something, you need a way to make sure that you increase the trading capital, you increase how you fund the business, the money the business generates. So what I usually advise people is that if you are trading cryptocurrency, if you are just starting out, so it depends on how you can manage your emotion. So I usually advise that for people that are just starting out, so for you to build your account, I usually advise that you start with 2% to 5%. So when you have built the account to something like, let's say $5,000 now, or $10,000 now, so that's when you can be thinking of doing 1%, because the more capital you have, the less you'll be able to risk. So for example now, if you have $10,000 now and you are risking 1% of $10,000, that is $100, which is actually very good, because if you open a position with $100 with a good leverage or margins, you have a buoyant position size. We'll be talking about position size later in this lecture. You have a buoyant position size. Amount to be risk now. We have already known that in our trading capital now, if you are starting with $1,000 account now, so the amount to be risk, amount to be risk now. That is just 2%. Let's just cap it at 2% now. So if you are risking your 2% now, so that means in a $1,000 trading capital, you'll be risking $20. What it means is that if you divide 1,000 by this $20 now, so what it means is that you can be wrong 50 times. That means you have 50 times to make mistake in your trades before you blow up your trading capital. But if you look at it along the line, you might have some trade that will do better and will cover up for the previous losses. So what this means is that you have chances of making mistake 50 times. That's why we have capped our risk to be 2%. Since we know this now, we know the amount to be risked, and we know that if you are risking 2% of this money now, we'll have chances of being wrong 50 times. I know it is difficult to admit that we'll be wrong, and I don't have to say this to suit your ego. That is how it is in trading cryptocurrency. You have to admit that sometimes you might be wrong, or sometimes you might get it right. So that is doing away with your emotion. That is what will let you know if you are wrong, what decision do you make in the market? If you are right, what decision do you make in the market? So those things has to do with you managing your emotion, because trading is a game of probabilities, so there are no certainties. Let's move to the next topic now, which is our stop loss. There's no crypto trading education, or there's no crypto trading trainer that will not talk about stop loss. It is very important because the market is very volatile, and the more you lose, the harder it is for you to recover. So that is why you have to keep your loss very minimal. So for example now, let's say you start with $1,000, like we have said earlier, and out of the $1,000 now, you lost 10% of it. So you'll be left with $900. How much do you need to recover in terms of percentage for you to go back to square one again? So we have lost $100. So it will now be 100 over 900 times 100 here. This is $100 over $900 times the 100 this thing now. It will give us 11.11%. So that means approximately you need 11.1 to return back to the initial trading capital. Remember that you lost 10%. So that means you need 11.1 to come back to square one again. So now imagine that you lost 20% of it, which is $200 now. So imagine you lost $200. So you'll be left with $800 from the trading capital. So 200 over 800 times 100 now. That'll be giving us 25%. So you need 25%. So the more you lost, the harder it is for you to recover, to come back to the initial trading capital. That is why you have to keep your loss minimal, because the math will keep working against you. You need more than what you lose to return back to the initial trading capital. If you lose 10% of your money, you will need 11.1% to return back to the initial trading capital. If you lose 20%, you need 25% to return back to the initial trading capital. So the farther you go, the farther you lose, the more it is harder for you to recover your trading capital. That is why it is important to have a good stop loss. And you know, if you have lost now, let's say for example now you lost 50% now, so 50% you'll be left with $500. That is 500 over 500 times 100. You have to recover 100% of your money back. 100% of this, your trading capital that you are left, to return back to your initial trading capital. You see, it is getting harder as you are losing more and more and more. It is getting harder to recover your trading capital, let alone saying you want to make profit. So that is why you need a very strict risk management, and part of risk management is to have stop loss in every trade. So if you keep losing money, it will get to a time that the trading will become a gamble. You just want to play whether if you open this position, whether you can make your money again. Open another position, whether you can make your money again. So your trading strategies become irrational, and it's at the end of the time it will end badly for you. So the next point is So how do we calculate our stop loss now? This is very important because the majority out there trading cryptocurrency, the mistake they make is that when they open a position, they calculate the percentage they want to lose out of that position. So let's say, for example, now I open a position and it is a $400 position. So what most people do is that they say, okay, I'm ready to lose 8% of this position, or I'm ready to lose 10% of this position. It is a very wrong way to calculate stop loss. Stop loss should be calculated using technical analysis, our TA. So in future lessons, we'll be showing us how to use technical analysis to determine our stop loss. And again, our stop loss has to be below our entry point, which might be the support level. It has to be, if this is the support level now, it has to be way below the support level. Our stop loss will be around somewhere here if we are longing the position, and if we are shorting the position, it will be the opposite of it. Our technical analysis is what will determine our stop loss. So let's say, for example, now let's take an arbitrary stop loss. Now let's say I've done my technical analysis and I look around and my stop loss is around, let's say, 2 point. It will not be an exact figure. Most of the time, if you, from your technical analysis too, the stop loss might not be an exact figure. It might be like 2 point, let's say 3 something. So approximately, I can just shift this to, let's say, 2.5%. That would be my stop loss, 2.5% from my entry point. Not, take notes now, not the position I'm opening, 2.5% from my entry point. This is what we should always keep in our mind, that our stop loss has to be determined by technical analysis, not by you just picking an arbitrary percentage that this is the amount I want to risk, this is the percentage I want to risk in this particular trade. It doesn't work like that. It has to be determined by your technical analysis. So the third one now that we'll talk about here now, it is our position size. This is very important because initially, when you tell people that, okay, you have a trading capital of $1,000 and you are allowed to risk 2% out of this, that means you are risking $20 of this money. So what some people get confused about is that, am I going to open a position of $20 and if the whole entire trade goes against me, that means my whole $20 is gone? Actually, that is a wrong notion. You won't be opening a position of $20. What we are trying to say is that in every trade we are opening, we are not allowed to lose more than $20 on each trade we are opening, which means that we can go wrong 50 times, like we have explained earlier. How do we now do it? Position size we open, this is where margins trading or leverage trading like futures, this is where it comes in now, because these are the places where the exchangers can borrow you money, or the platform where you are trading can borrow you money. So for example, now some platform can say, okay, they are giving me 5x on a particular trade. For example, now if I'm bringing in $1,000 now, so this turns to $5,000 for me. That is what the exchangers will borrow me. They will borrow me 4,000 to hit, to make it 5,000 that I am having. So I can open a position from here now and put a stop loss that will not make me lose more than $20 from this position. So for every trade now, how will I know the amount of position I'm going to open? Or am I just going to open a position like that? So for you to know the amount of position you are going to open for every trade, there's a calculation towards it. We call it position size now. The calculation here is the amount you are willing to risk. The amount you are willing to risk in dollar all over the stop loss percentage. If we can remember very well, let's say for this trade, we are willing to risk 2% of our $1,000. So that means you are willing to risk $20. So 20 over our stop loss. From the previous example of stop loss, we have assumed a stop loss of 2.5%, which will be 0.025. So when we do the calculation now, divided by 0.025, will be giving us $800. So we'll be opening a position of $800 with this setup where we have a trading capital. For this setup now, we have a trading capital of $1,000. Amount to be risked now, we are risking 2% of it, which is equivalent to $20. Our stop loss now, our stop loss is 2.5%, which is also equals to 0.025, and the position size for this trade will now be $800. So what we are saying is that you won't be taking $800 out of your this $1,000 capital. The way it is that, like I've explained before, we have margins trade and futures trade, where the exchangers will borrow us money to trade. When you bring a certain capital, they multiply it by a certain number of leverage, or they calculate a leverage position you can enter for you. So if we have a coin that we can do up to a margin of 5x, and we bring in $1,000 now, so that means we'll be having $5,000 on that coin. So for us to risk 2% of our trading capital, which is $20, we will not open more than a position of $800, and this is the stop loss we are going to put. So the stop loss, like I've explained earlier, will be a percentage of our entry point. Not that we'll look at it that, okay, since I'm risking 800, since I'm opening position size of $800, what is 0.2% of this? That is not the way you are meant to do it. Because for example, now you have an entry point for BNB, let's say at $300. So if you open a position size of $800 from it, so you'll be having 2 point something BNB value. So from here now, you should calculate 2.5% of that entry point, which is $300, 0.5 over 100 times 300. So that will give us 7.5. For us to know where our stop loss will be now, we'll do 300 minus 7.5. You'll be having 292.5. So if you are opening a position of, if your entry point for BNB now, if your entry point is at 300, so your stop loss should be set at $292.5. So when the price comes down to this place, now let's say you long the position and the price comes down to this place, now the trade closes automatically. So from this position size now, you have lost $20 from opening of this position size. The point now is that, how do people now make money from trading if they have to set a stop loss and it is it, and all the time you have to accept that you are wrong and take losses? So what is that? What people don't know is that trading success, let me put it down, trading success is not a straightforward, it doesn't have a straightforward answer, because the philosophy behind trading is that it is not how many trades did you lose, and it is not how many trades did you win. It is the percentage of winning that matters. So that is why if you are trading, you have to open multiple positions. Like you have to be trading at least 5 positions at a time, if you can afford to, or 3 positions at a time. 3 positions at a time. So the reason why this is very important is that, let's take for example now, somebody opened 5 positions. So out of the 5 positions now, he lost 3 positions out of it. He was at loss at 3 positions. He was at loss at 3 positions. So the remaining 2 positions, he won the remaining 2 positions. So this kind of person now, who are we going to say he is a successful trader or he is a failure? So are we going to say the person is a successful trader or a failure? So it is actually not measured this way. What will determine whether the person is successful or the person is a failure is the percentage of winning. So let's say, for example, now, so in the 3 positions that he lost, the first position he lost $50. Second position he lost $50. The third position he lost $100, and fourth position he won $200, and the fifth position he was at profit $600. So if you look at the net amount here now, we'll be having something like this is minus 100 with this. So from here now we have minus 200. So this and this now we have plus 800. So minus 200 plus 800 will be having plus 600. So this kind of person now is actually a successful trader. So compared to somebody else that, let's say the person won, let's say the person did the same 5 trades and the person won in the first trade, the person won $100. Second trade, the person won $30. The third trade, the person won $50. And the fourth trade, the person lost $300. The fifth trade, the person lost $500. So if you look at this now, these 3 together now, these are where he won money. So this 3 trade is $180 altogether. That's plus $180. So these 2 trades now, that is where he lost money. So all this is minus $800. So if you do the calculation now, plus 180 minus $800 now, so that means you'll be having minus $620. Minus $620. But in paper, he won 3 trades and lost 2. So it will be looking successful more than this person that lost 3 and won 2. You understand the concept now that trading success is not based on how many positions did I win. It is based on, for the position that I won, what are the percentage the percentage profit that I made, and for the position that I've lost, what are the percentage profit that I lost. So what is important is to keep your loss as small as possible and to keep your win as big as possible. So that is how to keep a strict trading management, and there should always be a journal for you where you recorded the percentage win and the percentage loss, because at the end of the day or at the end of the week or at the end of the month, you should be able to track and see that, okay, in this month, okay, I have, let's say, 5,000% win and just 300% loss. So when you do the mathematics now, you see that you won more than you lost in this month, even though if the number of trades that gave you this might be like 50 trades, and the number of trades that gave you this might just be like 20 trades. So you have to keep a trading journal to know where to improve and where to work more better on it. So it is important that you keep a strict risk management for you to be a profitable trader. That is all we have to say today about our risk management, and don't forget to subscribe and like this video and turn on your bell notification for more videos on cryptocurrency.